Uh, Kindly hold for a while. So we are waiting for some more people to join in, and we will start the call in, maybe in a couple of minutes.
I think EVS, we can start now.
Yeah. Good evening, ladies and gentlemen. Welcome to ASK Emerging Opportunities Portfolio Quarterly Update Call. My name is AVS Ramakrishnamurthy, and I am the moderator for today's webinar. So we have with us Mr. Chetan Thacker, a portfolio manager who is managing ASK Emerging Opportunities Portfolio, and to update us on portfolio and his views on equity market outlook. To introduce Chetan, to all of you all, Mr. Chetan Thacker has total work experience of more than 16 years with 13 years plus in equity research. He has a sector research expertise in agriculture, chemicals, metals and mining, and mid-caps. Previously, Mr. Thacker has worked with McKinsey & Co., HSBC Invest Direct, MK Global Financial Services. His education qualification includes CFA from ICFA University and PGDBM from NMIMS. Mr. Chetan is associated with ASK since 2015. So in this webinar, Chetan will take us through his views of ASK Emerging Opportunities Portfolio, how the quarter gone by, and his views on equity market outlook. Opposed that, we have a question and answer sessions lined up. Request all participants to type your question and answers in question and answer session or chat box, so that post the presentation, we will curate those questions and get the answers from Chetan. Without any further delay, I will hand over the baton to Chetan Thacker. Chetan, over to you.
Thank you, AVS. Thank you, everyone. Good evening. Thanks a lot for joining us for this quarterly update call for the Emerging Opportunities Portfolio. As AVS mentioned, I'll probably take you through first with the macros, both global and domestic. After that, we'll cover the EOP portfolio in terms of the performance and the fundamental performance of the portfolio as a whole, post which we'll cover the actions that we've taken and the outlook going forward, and we'll then open the floor for question and answers. So starting directly with the global indicators, what has happened in the last 1 year is, as you can see from this particular slide, India has done well in the last 1 year, 3 year and 5 year time frame globally. So our markets have performed well in this period. This is also a period where we've actually witnessed a fair degree of acceleration that has happened on the GDP front. As far as India is concerned, there has been a lot more interest on the India story, given our demographic benefits that everyone is now acknowledging, and good 10 years of certainty as far as policy and governance is concerned, which is giving a fair degree of confidence on the Indian economy per se, which is getting reflected as far as the global performance is concerned of the Indian indices and the stock markets. Coming to more global events, I think the biggest worry last year was inflation. And what we've started to see is, yes, there was first leg which started with oil. Having seen fair degree of geopolitical volatility, we've actually seen crude move in a more narrow range at a lower level, and that has continued, which bodes well not only for inflation as far as we are concerned, but also it bodes well as far as global inflation is concerned, because we had seen a patch where this, coupled with loose fiscal policies, has actually accelerated the inflation bit as far as the global economies are concerned, which in turn led to the responses from central banks of tightening interest rates. Coming to the policy measures, I think Federal Reserve has been on a pause for some time. We've actually seen first cuts happen on the EU side, where we've seen inflation cool off better than what we witnessed in the US. Despite the sharp increases in interest rates, we still continue to see the economy doing well and holding out well. There are early indications that we are seeing some degree of cool off in demand, but not that much that it warrants currently an immediate reduction as far as the headline rates are concerned. The second big factor that had opened up, particularly on the geopolitical front, was because of the Middle East crisis. We had actually seen a fair degree of spike up as far as freight costs globally are concerned. We've actually started to see some degree of moderation there, though we are seeing the pain of higher freight costs flowing through most of the companies and also in terms of global freight rates. But the disruption, while yes, it has meant that the shipping routes have become longer by 14 to 15 days, there has been an increase in the cost because of the increase in duration of the shipping time. But we've seen the index remain fairly stable after some degree of spike, and it has not moved up significantly as it had in the period of the supply bottleneck era of 2021-22. Coming to the domestic backdrop, I think from a macro perspective, we've actually seen a good GDP print of 8.2%. So the macro growth continues to accelerate. This was primarily driven by government taking the initiative on the capex, and that has seen a follow through that has happened through the year of FY24. Inflation, on the other hand, as it has moved lower, as we've been highlighting for some time, that given the adverse monsoons of last year, food inflation remains a worry, and that has also kept RBI on a watch, and we've not seen the monetary action from RBI in terms of downward movements. RBI continues to maintain a pause. That is primarily driven by how food inflation has been behaving, and we are keeping a close eye there because the monsoons this time have become more crucial and critical. If we see a good monsoon, you'll probably see a cool off on food inflation that in turn will provide more monetary room as far as the RBI is concerned. Coming to the big event, which is now behind us, which were the election results. Yes, the results were not in line with what the markets was expecting. We've seen some degree of miss as far as the election outcome is concerned. However, looking ahead, I think the favorable outcome is that the current dispensation continues to remain in power, which means there will be continuity of policy as far as the government is concerned. We've now also seen allocation of portfolios to ministers, and it clearly shows that there is continuity of policy even on that front. So there is a fair degree of confidence that policy continuity will remain, the focus will remain on capex, the focus will remain on transition to green energy. So the priorities of the government will continue, and that bodes well as far as the medium to long term is concerned. From a very short term perspective, we expect volatility to still remain a bit high, primarily driven by how flows will behave both on the domestic and the FII side. So we are keeping a close watch there. But structurally, what we believe is if we see a good monsoon playing out in FY25, we formed a fair degree of stable base from where acceleration can happen of GDP growth. And we should see that follow through in FY25 and 26. What I would like to touch upon here is if you look at FY24, FY24 primarily was a story of two halves. The first half was where we were seeing normalization in profit margins, which was driving earnings growth for the listed space. The second half was expected to be largely driven by volume-led growth, but what played out because of a weaker monsoon was volume continued to remain very tepid. We'll cover that as we move ahead as far as the results are concerned, which have come out for the quarter as a whole and a year as a whole. So what we've seen is that volume momentum was weak in FY24. It was more of a function of how margin expansion happened, and that in turn drove profit growth as far as FY24 is concerned. Coming to more capex-led side of the economy, that is where the push of the government was, and that was driven by volumes. So you essentially saw capex part of the economy do very well, both in terms of volume growth translating to profit growth. The consumption side is where the weakness was, and that was primarily driven by how monsoons have behaved, and their volumes were sluggish. Exports, on the other hand, were a mixed bag, primarily driven by how global supply destocking was happening. What we gather now is probably we are towards the end of the destocking period globally. That means that looking ahead into FY25, exports, which was a headwind for FY24, our expectation is that will start to turn the corner and become a tailwind as we move into FY25, largely in the second half of the fiscal 25, where we expect first restocking demand to emerge. We've already started to see fair degree of price stabilization. This is in the backdrop of China continuing to dump a lot of inventory in the global market space. What we are now witnessing is that there has been fair degree of price stability now in the system. Coupled with that, if we start to see the restocking demand emerge, I think that will bode well from the exports perspective. On the domestic side, monsoons are a key trigger that we are watching out for very closely, and that in turn will determine what is the uptick that we see in the economy as a whole, particularly on the rural and the semi-rural side and semi-urban side. That is where we expect, if the monsoon plays out well, you will start to see uptick in volumes, and that is where we believe it should benefit not only the consumer discretionary space as a whole, but it will support GDP growth, which so far has been driven by capex. Coming to quarterly results, at an Nifty level, we've actually seen revenue growth of 6.6%. We've seen profit growth of 11.6%. Like I was mentioning, revenue growth has been tepid, primarily driven by a lower volumes and volume growth not picking up, given the macro backdrop what we were witnessing, particularly post-festive season. What has done well in this environment is clearly domestic cyclicals. We've seen a good earnings delivery from the automotive space, real estate, capex-driven businesses, and BFSI. Sectors such as energy, metals, and IT, which are to a large degree exposed to what happens globally, have actually faced challenges as far as earnings growth are concerned. And that is the pocket which still remains under pressure. Our sense is they should start to turn the corner as you move ahead into FY25 with stabilization in global GDP growth and eventual uptake as and when you start to see interest rates going down. Coming to sector specific, I think auto ancillary clearly stands out. What we witnessed was a combination of volume growth, lower commodity prices, which helped gross margin expansion. This was felt across the board, be it OEMs or auto ancillaries. The OEMs clearly benefited from an uptick in volumes, be it two-wheelers, four-wheelers, CVs. The ancillary players essentially benefited from a downward revision of raw material prices. That meant that gross margins expanded. After a very volatile input period of FY23, we've actually seen a fair degree of uptake in margins in FY24, more so in the third and fourth quarter, and fourth quarter has delivered a healthy print as far as the auto sector is concerned. Banks and NBFCs both put together, I think while the earnings delivery has been strong for FY24 for banks, as we look ahead, our expectation is you will start to witness cost of funds catch up, which in turn will mean that the NII growth may be lower than loan growth for some time. As you see that adjustment, clearly there is a pressure on garnering deposits in the system, and that can lead to some degree of upward pressure on cost of funds as well as banks scramble to essentially get more deposits, given the fact that they are running on the higher end of the credit deposit ratio. So there is yet some degree of liquidity constraint, which is putting a pressure on deposits. Having said that, the second bit, which is provisioning, which was low last year, our sense is that will get normalized in FY25. So to that extent, banks will clearly have a lever of cost to income in terms of PPOP growth, plus the loan growth that we expect with acceleration in GDP growth. While on the NBFCs, our view is that we've actually seen bottoming out of margins. Cost of funds have largely peaked out, so they should be the beneficiaries as and when the cycle turns. We've also seen repricing as far as their assets are concerned to an uptick on the interest rates that we have seen. Going forward, hence our expectation is that NBFCs are better poised compared to banks, and that is where we believe the earnings delivery will still continue, because you will start to see the first leg of impact whenever we see a loosening of the monetary policy play out. Chemicals and agrochemicals clearly in the eye of the storm as far as FY24 was concerned. This is the sector which witnessed not only volume pressure, it also witnessed pricing pressure, given how China has behaved globally. That meant that while on the auto ang side, you actually saw gross margins move up. This is one pocket where we saw gross margins move down, coupled with operating deleverage, which has impacted not only revenue growth, but has also impacted operating profit growth. As we look ahead, like I was mentioning, I think towards the second half of this fiscal, we start to see recovery from the exports. We've already started to see stabilization of prices. Our expectation is that in the more structural longer run journey of chemical and agchem space out of India, we've probably seen one downtick cycle that has played out. While it has been accelerated, it has been more than what was anticipated when the cycle started. Our expectation is that we probably bottomed out here, and you should start to see an uptick, and the journey again continues as far as the prominence of the Indian chemical and agrochemical space globally is concerned. On the consumer durables and electrical products, clearly the weather has helped, and we've seen the summer products do exceedingly well. Particularly the room AC segment has done really well. Volume growth in Q5 is also expected to sustain given the summers that we've witnessed. The cable and wire segment is clearly a pocket that is benefiting both from what is happening on the real estate side and also on the capex side. So it has a twin benefit, which has delivered higher volume growth, which not only has helped to deliver earnings growth, but has also helped in delivering margin expansion as operating leverage has also played out in an environment where input costs were gradually moving down. So it is in a sweet spot as far as cable and wire is concerned. You are seeing strong demand not only from the domestic side. There is a fair degree of opportunity on the exports front that has opened up. Coupled with that, we expect margins to still continue to remain healthy as operating leverage plays out. Coming to FMCG, this is a pocket which is an indication of how consumption has behaved. And here clearly we have seen low digit volume growth. That is a function of how the macro played out. The management commentary continues to point towards recovery in rural. Our sense is this will get accelerated if we see a good monsoon period. On the monsoon front, IMD, SkyMet, and other global agencies have forecasted that the effect of El Nino will start to wane out as we move towards the end of June, mid of July. There is a slight possibility of La Nina kicking in, which essentially means a period of higher monsoons, which should help not only the Kharif season that is ensuing or it will just kick off, but it will also help the Rabi season because that in turn will help uplift the reservoir levels which had run down significantly, and that is where you see a fair degree of news flow with a lot of cities also facing water crunch at this point of time. Coming to tourism, I think this is one space which has continued to do well. We've seen strong footfalls continue in this particular pocket, supported by events as well, which took place on the domestic front, such as the G20 meet. And per se, the domestic consumption of services, which has seen an uptick not only in India, but it has been a phenomenon globally, where goods consumption has seen some degree of adjustment back down post-COVID, while services demand has continued to tick up as far as consumption discretionary is concerned. IT continues to remain a weak patch, and that is primarily driven by how global macros behave. Our expectation is that FY25 will still continue to see tepid growth. The expectation here also is towards the end of fiscal 25, do we start to see some degree of loosening of strings as far as budgets are concerned on IT spends as interest rates go down. So our expectation is IT will still continue to remain patchy, while there are pockets where we believe growth will continue to remain accelerated, particularly the ER&D space, which is more exposed to autos, aerospace. This is the pocket which should ideally do well despite a weak macro environment. So as and when the macro recovers, those will probably be the pockets which will continue with the acceleration. Pharma, on the other hand, I think FY24 has been a good year for the pharma companies. We've seen the US portfolio see less of price erosion. We've actually seen shortages help as far as the companies which are exposed to the US side are concerned. On the domestic front, the volume growth has held stable. What has helped is lower input costs, particularly what was happening to intermediate pricing and the API pricing, given how China has behaved, which has helped improve gross margins for the domestic pharma players. So the operating profit growth has been higher than the revenue growth, primarily supported by how input prices have behaved. So we've actually seen expansion in margins. Looking ahead, our sense is domestic businesses will continue to deliver performance in line with FY24 as far as top line is concerned. Volume growth should typically translate to operating profit growth, while the environment on the US side continues to remain benign, and our expectation is that this will be a pocket which will continue to see earnings delivery happen in FY25 and beyond. Moving forward, I think India Inc. overall in FY24 has performed well, though the one complaint that still can be there in terms of numbers is it was on the back of lower volume growth, which particularly impacted the consumer discretionary side of things. That is also a sector that we continue to like and has been a sector which has underperformed for us at a portfolio level. While looking ahead, our expectation is if we see a recovery, particularly driven by how monsoon should behave, this is one pocket which provides a structural growth story because you get to play both penetration and premiumization as far as consumer discretionary is concerned. So volume growth in general should start to see an uptick. It's a question about when we start to see an uptick. So our assessment is if you see a normal monsoon, while the agencies have estimated that you'll see an above normal monsoon, If the spatial distribution is right, you will typically see this patch starting to hit as far as volume recovery is concerned, somewhere towards the end of the second quarter, beginning of the third quarter. So that is when you start to see volume recovery happen at a more broad-based level. Coming to FY25, there are clearly few headwinds as well. One headwind is the geopolitical tension, which continues to remain there, be it Europe or in the Middle East. So we are not seeing any signs of that getting cleared off as of now. Looking ahead, if you probably don't see a good monsoon, I think then that becomes a headwind as we look ahead, given where valuations are and where the expectation of earnings delivery is. From a government point of view, our expectation is continuity of policy will mean that the government capex still continues. I think July is where we see the first budget for this year, because the Feb budget was more an interim budget, which was just a presentation of the financial numbers. We'll actually see a full budget getting presented in July. That should point towards the next 5 years as far as government priorities and focus is concerned. While our expectation is, given the speeches that we've seen so far, there will be continuity on capex, there will be continued focus on the sectors which have been doing well. So you will see that remaining in focus. Budget should provide a fair degree of clarity on that. Coming to the portfolio, I think what we've been talking about for the last 2 or 3 quarters now, very clearly we've seen a higher churn, higher activity on the portfolio. This was on the backdrop of, like I covered last time, there is a fair degree of increase in agility at our end. We have been more agile in terms of looking for new ideas, booking profits in certain names. So you will see stocks such as Honeywell, which would have been bought in the quarter, exited in the quarter after making a fair degree of return in that particular name. In this particular quarter, we've essentially added Varun, Gravita, and Honeywell, while Honeywell has given us decent returns and we've exited from that position. So the net addition remains Varun and Gravita in this portfolio. Both these stocks clearly are where we see a medium to long-term tailwind. Varun is a clear beneficiary of the consumer discretionary spend, not only in India, but we've seen them expand footprint in the global market as well, with expansion in the African territory, which is where we see they've become a very dependable partner for Pepsi. And Pepsi has been giving them certain markets where they also want to turn around performance. So Varun remains a clear beneficiary of both domestic and now the export bit or the international bit of the story. Gravita is a name which is a niche player on the recycling side. We are seeing clear tailwinds as far as the recyclers are concerned. You've seen the rollout of EPR, which is the regulation to process or recycle your commodity which you're using. So EPR has been rolled out for rubber, and that starts to kick in from this fiscal itself. We've already seen fair degree of rollout happen on the plastic side. So if we zoom out a bit, I think globally there is a very clear focus on circular economy. As we look ahead, as all countries start to hit or want to hit and aim to hit their carbon reduction targets, recycling will be a bigger play. You will start to see that play out. There is a clear focus on circular economy, both globally and in India. So there is a fair degree of tailwind. Our assessment is recyclers will benefit from this ecosystem. You will see a higher push as far as the requirement of circular economy is concerned, and partners in that journey, because most of the bigger companies will actually look for partners to not only meet their requirements today on recycling, but at some stage to take this circular economy at full throttle, saying that can we reutilize what we've already used and use them as inputs again as we go ahead. So Gravita is a clear beneficiary of that particular part of the economy and the opportunity that has opened up. Coming to the portfolio performance, for the quarter as a whole, I think at an aggregate, the performance has been in line with expectation. We've seen 18% operating profit growth, while Nifty 50 has delivered 11% operating profit growth. As we look ahead into FY25 and 26, we expect operating profit growth to remain strong at 27% and 28%. The caveat here is the FY25 number and 26 number has actually been built upon an expectation of recovery on the consumer discretionary side and expectation of recovery on the consumption side of the economy, which not only will help the direct consumer discretionary space, but will also help accelerate private capex. So far, we've seen government take a fair degree of the burden of capex. Given where utilizations are across a lot of industries, our assessment is that you will probably start to see a revival as far as private capex is also concerned. So if consumption does well, there will be a vicious circle impact that will not only impact the consumer or the consumption side of the economy, it will also have a ramification on the more private capex-led bit of the economy. While from a global perspective, I think exports this year should start to see a tailwind, which was a drag as far as FY24 is concerned. Coming to the performance, I think in the shorter duration, you are starting to see some degree of turnaround as far as performance is concerned, be it the 3-month or the 1-month performance. The endeavor clearly is to catch up on the underperformance of the last 3.5 years, particularly the last 2 years, where we've seen a fair degree of underperformance. So the idea, like we were mentioning in the past 2 to 3 quarters, is can we catch up 150-200 basis point organically with the changes and efforts that we are making at our end? While there is a fair degree of tailwind that can happen whenever cost of capital globally goes down. So that is something that we do not pencil in as far as our return expectation is concerned. It is over and above what we expect from the portfolio to do organically by way of delivery on earnings. So whenever that tailwind plays out, that will be over and above what we expect in terms of returns going ahead. In terms of composition, 28% of the portfolio is large cap. It continues to remain predominantly mid cap and small cap. The idea clearly is to keep this ratio here while we essentially want this portfolio to remain a small and mid cap portfolio. And we are looking at opportunities in that space because our expectation is as GDP growth accelerates, you see a lot more pocket that starts to get opportunity to expand and grow over a medium to longer term. And that is where we are hunting for opportunities at this point of time. And that is where we are populating the portfolio. Coming to the psychographics, it continues to remain a high quality portfolio. ROCs are upwards of 35% for the portfolio as a whole. EPS growth again is upwards of 20% at an aggregate level. The interesting thing to notice here is valuations. So valuations, like we've been mentioning for some time, have seen compression. This is primarily driven by the fact that despite earnings not disappointing for the last 3 years, we've actually seen derating of the portfolio. Looking ahead, our expectation is that this portfolio will eventually see some degree of re-rating whenever you see cost of capital go down. And you should ideally get catch up as far as the delivery on returns is concerned for the earnings delivery for which we have not seen that kind of return delivery on the portfolio. So the PE ratios continue to remain lower. Our sense is there is an opportunity of re-rating here if the earnings delivery continue in line with what we've already seen for the last 3 years. In a bad period also, we've actually seen 17-18% OP growth for the portfolio as a whole. So earnings growth has not disappointed. We've seen or we've borne the brunt of the derating. And in terms of global interest rates, we are probably towards the peak. So our sense is the quantum of that impact to be negative is low, while there is an opportunity for that to reverse and we can start to see some degree of re-rating whenever cost of capital goes down. This chart clearly tells you how the PEs have moved for the portfolio as a whole. So as you can clearly see, of March 21 and then you compare to March 23 and March 24, 2 year forward, it's moved down from 42, it moved down to 33.6, 30, and today we stand at a 25. So clearly there has been a derating while earnings delivery has happened. Our sense is this will start to turn the corner as well. I would again like to say and clarify that as we look at this portfolio in terms of catch-up of performance, we organically do not factor in the re-rating that can happen, and that should be over and above what we expect in terms of return delivery for the portfolio. So I'll just take a pause here and I'll open the floor for question and answer.
Thank you so much, Chetan, for your brief update on emerging opportunities portfolio and your views on markets. Now, participants request you to kindly type your questions in chat box or Q&A session so that I will ask those questions to the Chetan to get the answer from him. So meanwhile, Chetan, we are also curate some questions from our distributor partners and the investors. So we have seen election results are out and we have seen the coalition government has formed in Central. There are two questions to ask on that. How do you see the government spending going to happen in the sectors which already are positioned in the portfolio? And second, is there any revival of the portfolio if government focus changes into the more into the social welfare and schemes? And how do you position the portfolio at that point in time, keeping in the mind that next 2 years we may see some state elections are also lined up.
So anyways, on that front, I think the last 1 week has given some degree of clarity. If you see from 4th of June till now, what has been negative has been the fact that you've not seen the government come with full majority and you are again seeing a coalition government. What has been positive in the last 1 week clearly is the way the ministries have been allocated. There is a clear focus on giving the ministries to performing ministers back. That means the focus still continues to remain and policy continuity still remains. They still continue to be in majority, and that in turn provides confidence that the policies that were there pre-election, we will continue to see those policies play out as we look ahead. So what were the sectors which were clearly benefiting from government policy? Clearly, one was capex. Our sense is capex will still continue. Second bit was on defense. Defense again has emerged as a need not only at a domestic level, but India to a certain extent has now started to export as well, given the constraints on the global defense space that we are witnessing, given two geopolitical tensions both in Europe and Middle East. So that means there is an opportunity on the exports front as well as far as defense is concerned. The third bit is primarily within a part of capex itself. Is there was a clear focus on railways. Our sense is that focus will continue, given that there is a continuity as far as the minister itself is concerned. On the ministry side, roads again remains a focus area, and we've again seen continuity there. So our sense is road, railway, defense, you should see continuity of policy. What can happen, and I think that is where we are waiting for the budget, is in terms of how allocations will move. So if you just step back a bit and look at what has happened over the course of last 3 years, clearly you've seen an acceleration as far as capex is concerned. From a budget allocation point of view, you moved from 5 lakh upwards of 10 lakh. The interim budget put a number of 12 lakh. So our sense is very clearly, it points in the direction where the intent is. The question can be whether it will accelerate from 12 lakh or whether it will probably undershoot a bit compared to 12 lakh. Even if it remains at 12 lakh, it essentially means that we've moved from an era of where we were seeing capex spend of 2.5, 3 lakh to probably 4x that number. So while if you do not see an absolute big growth as far as the capex spend itself is concerned, the base has gone up significantly already. So that clearly means that capex as a spend or capex as a sector will continue to remain in focus. The reason why capex is more important is because you see the highest ICOR there, which is return on every invested rupee. It has a very large multiplier effect, and I think that is where the focus remains to ensure that there is still a wide gap in terms of what infrastructure is needed at a country level and where we are. We've covered a lot of distance, but there is still a long way to go as far as the capex needs itself are concerned. So our sense is, having seen how the ministries have been allocated, clearly it points towards continuity of policy. We will get more clarity in terms of numbers when the budget comes into the picture, because given that this will be a first budget for this 5-year term, it will clearly say where the direction is for the next 5 years. So if you look at the term starting 2014 or the term starting 2019, it clearly the first budget gave a vision for the next 5 years. So our sense is even this budget to that extent will give a vision for the next 5 years where the policy focus will remain. Having said that, even if we see some degree of monies move towards the social end of things, our sense is that in turn will support consumption. That has been a patch which has been worrying for the last 1.5 years, where consumption has been lackluster. Our sense is even if some monies are moved there, and so long as we remain within constraints of fiscal deficit, our sense is that you will see acceleration on the discretionary side more than the staple side. And that is where we have a higher exposure in the portfolio as well. So you've got a higher exposure on the discretionary side of consumption as opposed to the staple side of the portfolio. So the portfolio to that extent is balanced. If you look at a culmination of the overall weight in the portfolio, if I were to club a large part of subsectors which we now club under manufacturing, so if I were to club chemicals, pharma, auto ancillary, the defense exposure that we have in the portfolio, today we would be upwards of 40-50% as far as the manufacturing exposure is concerned in the portfolio. We'll be upwards of 15% as far as the consumer part of the portfolio is concerned, again with more focus on the discretionary part of the portfolio as compared to staples. So clearly the themes that we were playing earlier also, those continue, while we'll get some degree of clarity on how the budget allocations move. But our sense is, even without the allocation, if you actually see a reasonable monsoon that happens this year, you will see pent-up demand play out. So FY24 has actually shown that two-wheelers has been a classic pocket where pent-up demand has played out this year. One good summer season has clearly pointed towards how the AC demand has just gone off the roof, given the pent-up demand that has played out there. So it's more a question of, as earnings start to move up in terms of the economy as a whole, and it starts to touch a larger strata of society, there is a fair degree of pent-up in the system that is there to play out. So our portfolios are geared towards both these sectors at a very macro level.
Yeah, thank you so much, Chetan. So, the questions are coming in the Q&A sessions. Now, the first and foremost question starts with the performance. Though, shorter term, we have the changes what we have made in the portfolio from last financial year, it is clearly evident that in our portfolio is slowly bouncing back in terms of, in the short term, it is clearly reflecting in terms of alpha. But in the longer term perspective, those who have invested, say, for example, who have invested in our emerging opportunities fund, which is we are launched in AIF platform in 2021, still the gap between the benchmark, the BSE mid cap and in our portfolio return is very huge. I can say that 12-13% gap still is there for the longer term since inception. So what confidence you're going to give to the investors who are there in the call to bridge the gap between the portfolio return and the benchmark return going forward?
So I guess if you were to just step back a bit and look at the last 3 years, what has happened? So like I was mentioning, have we seen underperformance or under delivery on earnings? Clearly the answer is no. We've actually seen delivery being better than what we were penciling in the last 3 years at a portfolio level. What has hit us clearly is how cost of capital has behaved. So that has been a large part of the negative impact or a drag that has been on returns from translation of earnings to returns is concerned. If you were to analyze that, our sense is that given the rate at which cost of capital went up, anyone who was more exposed to our style of investment, which is high quality, high growth, would have seen that impact, because in a high growth strategy, your cash flows are in the future. Whenever you see such a sharp revision on the denominator, which is cost of capital, you see an upfronted hit as far as derating of the portfolio is concerned. Having said that, as we look ahead, and that is what we've been covering in the last 2 to 3 calls, is that we've probably hit the peak as far as cost of capital is concerned. It's a question of a time when that starts to reverse. Whenever it starts to reverse, you will again see re-rating. So I'll just come back to the last slide which I had shown. So you've actually moved from a 2-year forward PE of the portfolio from 42 today to 25. Yes, there would have been an impact of the churn in the portfolio itself, which has got the PE down. If we were to knock that off also, our assessment is you would have still seen a 25 to 30% derating of the portfolio, primarily driven by cost of capital. So whenever you start to see a reversal here, this is what will catch up. Having said that, when we look at the portfolio year on, and that is what we've been highlighting for the last 2 or 3 quarters now, is that organically bottom up, our expectation is, or our focus area right now is, can we catch up 150, 200, 250 basis point each year organically in the portfolio by way of making the changes, by way of actively changing the portfolio? Over and above this, whatever we get in terms of re-rating because of how cost of capital behaves, that is something which we do not capture in today in terms of our return expectations. So that will be over and above this. Like you rightly pointed out, we've actually seen some green shoots as far as the short-term performance is concerned. Our expectation is we continue to deliver on those green shoots. Having said that, what this essentially also means is, compared to the way of functioning earlier, right now what we've changed is, we've not changed our investment philosophy. We still continue to remain high quality, high growth. We've got some degree of flexibility as far as our erstwhile buy and hold strategy was concerned. We would have earlier held on to a lot more businesses for a lot longer period of time. What we've changed essentially is that if we are seeing an initial gratification in terms of returns for the names that we've participated, we are booking profits and churning that part of the portfolio. Given how markets are and the increased volatility both on upside and downside, what we've seen is, yes, there is a much faster repricing of things as far as stock prices are concerned. So we want to take advantage of that. Wherever we see a repricing happen, which is faster than what we were anticipating, we are booking profits and we are churning the portfolio. So just to share some examples, something like an Alchem lab, we would have delivered 50% kind of returns. While we would have expected this kind of return over a period of 2 years, we got the delivery in 9 months, so we booked profits and moved on. Similarly, on Honeywell, that I had covered in this slide, which is again an entry and exit in the same quarter. While it's an entry and exit in the same quarter, we've actually seen 25% delivery in this one quarter itself, as far as the performance is concerned. So that is why we said that if we see a very fast gratification of what we want from a particular name, we will probably move out and hunt for a new name. And that is how we are actively trying to capture that additional 150, 200 basis point as well. So it's again a part of that entire journey of where we want to and how we want to recapture the underperformance that has happened, while leaving the re-rating bit to play out as and when it plays out. So yes, this will mean a higher churn for the portfolio. Have we diluted our investment philosophy? The answer is clearly no. We continue to remain high quality, high growth focused. We've become a tad bit more agile compared to what we were earlier. The reason simply is that there are certain pockets where we see an upfronting of earnings delivery, while longer run it still might be tad lower than what we would have anticipated or what we like for our portfolios. But if there is a gap in terms of value and there is an upfronting of earnings delivery, we would want to participate there, book profits and churn the portfolio. So that is how we are essentially approaching this for the last 3-4 quarters. And again, whatever change we make today, it takes its own time to play out, simply because the fact is the earnings delivery has to play out for the stock performance delivery also to play out. So it is that period that is more of a wait period. The actions that we've taken in the last 15 months, you're probably now starting to see green shoots of that in the last 3 months period. Our sense is as we look ahead and if we see earnings delivery in line with what we expect from the macro front and even from the micro front at a company level, it will mean that it should continue to happen as we go ahead into 25-26. On the flip side, our degree of tolerance to names which don't deliver in line with our expectation has also increased. So that clearly means, or gone down, so to say. So that clearly means if we don't see a company delivering in line with what we anticipated, we will probably take a much more keener, closer look and take actions much faster than what we would have earlier done. Because earlier we would have given a fair degree of time for those companies to recover because structurally we would have liked the company. There can be patches where you see this impact because of macro. Not all businesses, or probably none of the businesses are linear as far as their delivery is concerned. So there was a higher degree of tolerance of the under delivery in a particular name. So that tolerance level has gone down, which clearly means that if we see names which don't deliver for us, we keep a very close eye view that if needed, we'll exit from the portfolio.
Yeah, thank you, Chetan. You also answered other question which was there in the chat board on our investment style. Thanks for that. And the question coming for the valuation side. Okay, we have seen last 1 year because we have more exposure in 70% into mid and small caps at this point in time in the portfolio. The last 1 year we have seen good amount of expansion happen in the mid cap and small cap benchmark. Like say for example mid cap from I can say 20 to 30 times it has been expanded. Small cap from 15 to 19.5 times it has been expanded. Going forward, how do you see this type of valuation? Because already we have seen the good amount of rally happen in the mid and small cap. What is your view on next 12 to 14 months? If PE multiple, how do you see the PE multiple and how our portfolios valuations are in line with that particular thing? Do you want
so
to
as
change
far as our portfolio valuations are concerned, we are at 25 times 2 year forward. While the index would be upwards of that today, be it the small cap index or the mid cap index. Clearly, the large cap index has not delivered in line with the re-rating that we've actually seen from a mid cap and small cap index perspective. Looking ahead, our expectation is, while so far everything was very broad based from a cap perspective, internally as a house, we don't clearly bifurcate things on market caps. Our focus clearly is to identify bottom up quality companies and populate the portfolio with those names. There is a bias towards mid cap and small cap, so we look at those quality companies in that particular pocket. Looking ahead, it will become much more stock specific. So any company which delivers in line with the higher expectations now that have got built into those names, you will continue to see them doing well. Companies which fall short of the expectation delivery, you will actually see a very sharp repricing on the downside. So clearly, last 2 years has shown us that both repricing on the upwards and the downward side has become much more accentuated, much more quicker. That essentially means to that extent that you also need to respond or actively respond ahead of that. So clearly, if we see names which don't deliver in line with expectations that are built in, even on the index side, you will actually see them underperform. So it will become more stock specific as compared to the more broad-based rally that we've seen in the last 2 years. So our sense is focus will now again shift back more to how each individual company delivers in line with the expectations that have gotten built into those names.
Yeah, thank you. Let me take you some stock specific questions which are all lined up. People are asking on the Go Fashions. Obviously, last 1 year, if you see, it is not contributing overall return of the portfolio. And last 1 year, it has not delivered any return kind of thing. So what is your rationale to stick on to the stock at this point in time?
So on Go Fashion, clearly what has happened is macro has obviously adversely impacted Go Fashion also. The weakness in consumer discretionary has also played a role as far as the delivery of Go Fashion is concerned. In an environment where the macro was weak and they continued with their store expansion, that meant that while OP growth was not as bad compared to our expectation, it is below operating profit where the profit has happened, given the fact they continued with their store expansion in a weaker macro environment. So that has meant that those new stores are not delivering the kind of throughput that those stores were expected to deliver. Having said that, like I mentioned, that our tolerance for under delivery has gone down. So we've kept a very close eye on Go Fashion. We've trimmed some degree of positions on Go Fashion. We are still keeping a very watchful eye there. If we don't see delivery recover in line with what we expect, probably we'll have to then decide what we need to do with that position. So it's not only Go Fashion, any name in the portfolio which is not delivering in line with what we expect, and where we don't see a visible recovery in a very short term period of time, we will probably take much more quicker actions as compared to what we used to do earlier. Is it structurally a bad business? The answer is no. So it is probably a victim of the environment itself. So clearly, if that headwind turns into a tailwind, you will actually then see operating leverage play out because you've seen store expansions already happen. So a revenue growth will probably see a higher translation to OP, and that will see a much more higher translation to PAT. So we are cognizant of that, but we've kept it under very close watch at this point of time, reducing some weights, but we'll take an adequate call as we look ahead.
Yeah, thank you. So another stock which is in the portfolio, Sirma SGS, which is into EMS player, is also dragging the portfolio return in a near term. But we have more companies which are like Dixon, which you have exited. That is a different story. That stock is doing well at this point in time. So what is your view on Sirma at this point in time?
So Sirma again clearly is the beneficiary of the entire EMS space. So if you look at the delivery of Sirma in this last year that has gone by, the expectation was that they'll deliver close to 3,300 crore of revenue. They've delivered on the revenue front. What has been missed is clearly the margins. Given the business model of Sirma, it deals with a lot more customers from a lot varied sectors. Each sector has their different margin profile. Each product within the sector will have a very different margin profile. So what revenue gets booked from what particular segment, product, customer will determine the outcome as far as the margins are concerned. This is more on a very near-term perspective. As you just zoom out a bit and look at the opportunity remains immense. So if you look at the guidance that Sirma has delivered, so they've said that for FY25, they probably will target somewhere between 44 to 4,500 crore of revenue. So clearly the growth remains. If they get the intended mix which they want, as they move or journey from 3,200 crore to 4,400 to 4,500 crore, clearly you will see a margin expansion. Similar to Dixon, what you highlighted was, if you look at the space which is Dixon / Amber, these were more contract manufacturers. The first leg of the journey, whenever contract manufacturing opens up, is clearly on just pure assembly. It is as you move ahead in time as you mature, you start to look inward to see what can I manufacture in-house compared to the components that I'm sourcing today, which is where slowly and gradually you start to improve your margin profile. Slowly and gradually you start to add to the value added part of the portfolio itself. So clearly EMS today is on the first bit of that journey, where you are actually today seeing a fair degree of assembly that is happening at this point of time. At some stage you will then start to see value addition happen. So that clearly means that in terms of products, even while though they will be assembled, you will see an opportunity open up for much more value added products that are getting assembled. At some stage you will also see some degree of backward integration play out, as they then have a fair degree of heft as far as their sourcing requirements are concerned, and that in turn will mean that deploying capital there makes sense. So it's a journey. Our sense is the opportunity is fairly large. Yes, we've been disappointed as far as the margin delivery for Syrma is concerned. Are we disappointed with the opportunity? The answer is no. That opportunity has played out clearly from a top line perspective. But while there are these micro headwinds that happen in a year in that journey, where you see patchy delivery on margins. Having said that, again, we are keeping a very close eye here. The reason simply is it has not delivered in line with what we have expected Syrma to deliver in terms of returns. So we are keeping a very hawk eye here to see how the delivery happens in the next quarter or two. And if the delivery is favorable in line with what we today see, you will see a recovery that happens on the stock price itself. If we again see an undershooting on delivery, then probably we'll take a call as and when we hit there.
Yeah, thank you. So one more sector or people are looking is closely is that chemical sector. You also mentioned in your presentation that maybe in a second half of the financial year we may see the chemical sector should see the play out will happen. In that line, we have Navin Florin in our portfolio, and which is again dragging the portfolio. So what is your view on Navin Florin and some more light on chemical sector kind of thing?
Yeah. I think AVS, you pointed out Naveen, I will probably point out Sudarshan Chemical as well in that light. So what is happening on chemical space, if you were to just take a step back and see, is there were certain sectors, particularly on the discretionary side as end user industries, which got impacted first. Anyone who was a supplier to that side got impacted first, very clearly. Then there was a space on the end user industry side, which was chugging along at a stable rate. Probably in COVID got a boost, given how supply chains expanded. That meant that people wanted to store more, have higher inventories. That continued to do well, even while the discretionary end user side was doing badly. So if I were to just split this into two, Naveen was probably at the first leg of the journey in the non-discretionary side of things, which is more exposure to AgChem, more exposure to pharmaceuticals. That is where clearly you saw supply bottleneck benefit, you saw capexes continue, and you also saw an upward movement as far as pricing is concerned, primarily driven by how supply bottlenecks behaved and how China behaved. While the discretionary side, which is where a Sudarshan Chemical sits, saw that impact first chin up. Even while Naveen was doing well, Sudarshan was doing badly in that environment. As we moved ahead, you again saw that cycle reverse. So cycle which was impacted first has reversed first. So we've seen a reversal as far as Sudarshan is concerned. Our sense is, gathering from the managements that we are meeting and we are discussing, clearly capex has not stopped on the chemical side. So that clearly means that structural story still continues to remain intact. Capexes typically happen when there is a fair degree of visibility from the customer as far as offtakes are concerned. So you will continue to see, and you still continue to see, news flow on contract manufacturing and contracts being signed for a longer term period in a lot of these chemical names. So clearly there is a medium to long term story here where the world wants to move incrementally away from China. Will they move completely from China? The answer is no. Our assessment is incremental demand. India starts to see an incrementally higher share of that demand follow through. So that clearly comes from the capexes that still continue today. Having said that, from a more near-term perspective, given how destocking has behaved, given how China has behaved in dumping a lot of these chemicals into the global market space, which has impacted not only volume but also pricing. And pricing in turn means that while volume hits in terms of deleverage, pricing clearly hits in terms of gross profit. So you will start to see reversal of that. Last year was probably a peak of pain as far as that cycle is concerned. Our sense is we've seen a bottom of that cycle itself. So we've seen a peak of pain already happen in the third quarter, to a certain extent, first half of fourth quarter. So our sense is you will start to see reversal. Will that reversal be a V shape? Today our expectation is the reversal will be a U shape. So our assessment is that you will start to see reversal that happens in the second half of the fiscal year, and you gradually get back to the journey which had essentially got lost in this year and a half period. So that sector continues to remain in a structural tailwind. We are today seeing a very short-term cyclical downturn. Having said that, is there an opportunity to make money even within this cycles as it goes through? Clearly, if you look at Sudarshan, which is a part of our portfolio, has delivered exceedingly well. So that is up 50-55% from the time we bought it in the portfolio in a very short period of time. That clearly tells you that when this cycle turns around, you will actually see a reversal of the returns as well. Naveen in particular got also impacted by management change. As we speak, last week we actually seen finally they've concluded on the search for a new CEO. The new CEO has been appointed for a tenure of 5 years. He takes charge from end of June. So our sense now is that now clearly the management disruption or change that had to happen has happened. The market will take its own time to take an assessment of how the new manager or the new CEO is. And at that point of time, you will again start to see confidence start to get built in the name. While this was happening in terms of delivery, our sense is you've seen a bottom of the pain period, which they also had in terms of both the refrigerant business and also the entire CDMO bit, which is more batch processing business or business which comes in batches and batches, more closely linked to their R&D side of the cycle of their clients. So if R&D gets pushed out, which is what you had seen on the pharma side, players like Naveen or an AMU Organics, which are again clearly linked to pharma, they get impacted. So whenever you see that upward reversal happen, you will start to see that revenue uptick also happen. Having said that, for Naveen's case in particular, there are large long-term contracts that kick in. A lot of them have kicked in already this year. You will see those getting fully ramped up. Capexes which have already been announced will get ramped up. As we look ahead, as the environment improves, there is a clear intention of not only ramping up capex in the existing businesses, while they are also looking at opportunities on new verticals as we look ahead from a medium to long-term perspective. The entire shift that we are seeing of electronics getting manufactured in India also opens up a very large opportunity for electronic chemicals in India. So all of this manufacturing will require chemical, will require gases, so that entire ecosystem has to be built. And clearly companies which have a strong chemistry capability, balance sheet strength, cash flow will be able to capture this opportunity. So yes, chemicals has been a pain point for us for FY24. Some silver lining even within that, likes of Sudarshan. But our sense is that PAC as a whole should start to see recovery in 25. From an earnings point of view, it's second half when we start to see recovery.
Thanks, Chetan. Thanks for your answer. So let us talk on some of the portfolio stocks which you have added, which has done very well for our portfolio, like Kirloskar Oil Engines, BHEL, REC, which are into capital goods and power sector. So what's your view on the particular sector and on these names like Kirloskar and REC and BHEL?
So like you mentioned very clearly, these are derived beneficiaries of the capex cycle itself. So power demand. So if manufacturing in India has to go up, if the country gets richer, there is both a demand coming from the manufacturing side and the household side as far as power is concerned. We had seen a period where you actually did not see any thermal capacities getting added. So that meant that existing plants started to operate at near optimum capacity. That meant that a cycle of capex on the power side was just waiting to kick off. And that is where a lot of these names are beneficiaries, be it BHEL, be it REC, which is a funder of the entire power capex. So our sense is, even if you look at the revision which the likes of BHEL would have done in their expectation, so 3 years back, they were talking about 35,000 megawatt getting added in 5 years. Today, they are talking about a number of 85,000 megawatt getting added. So clearly, yes, there is a large push on green energy. There is a large push on solar that will happen. But thermal has its own role to play as far as base capacity is concerned. So if you want manufacturing to operate smoothly in the country, if you want power 24/7, there has to be a balance which is struck between base capacity and peak capacity management. So our sense is both of these will continue. Renewable will continue. That is where the India's commitment is as far as reduction in global carbon is concerned, or emission from India is concerned. While you will also see a recovery on the thermal side, given the requirement for base load. So that bit in turn drives a lot of demand for other sectors. So if you see a thermal power or power capex starting to happen, you see requirement for capital goods which are associated with that capex also start to move up. Financiers start to participate, so that entire ecosystem in a way starts to participate. Kirloskar oil or coal is again a beneficiary of what is happening both on the industrial side, the entire data center opportunity that is opening up, and the fact that on the real estate side also, you see a fair degree of tailwind as new buildings come up. There is always this mandatory requirement, particularly for taller buildings, hospitals, airports, railway stations, where you mandatory need a backup generation system to take care of the load, even because you cannot have a split second of blackout in those particular facilities. So it is a beneficiary of both domestic as well as the export opportunity that is opening up as far as how things are placed. Power again is very interesting. It's not that India is the only country that is seeing an uptick in power. We are clearly seeing a lot of reinvestment happen as far as power is concerned, be it in US, be it in emerging economies in the Middle East as well, and on the domestic front. So clearly there is a thrust of replacing a lot of power capexes. There is a fair degree of requirement to also replace the older distribution and transmission lines which were there in the developed world, which have probably run down their useful life, and you will see capex revival there as well. So that in turn means that there is domestic opportunity. There is an opportunity on the export front. We are clearly seeing green shoots, even when you look at the cable and wire companies that have done significantly well this year. They've not only benefited from what is happening in the domestic market, they've also benefited from what is happening on the export market. So there is this combination of tailwind that is expected to play out on that.
Yeah, exactly. Thanks for that. So one more question I want to ask you on the another consumption side. Radico Khaitan. Why are you holding at this point in time Radico Khaitan? Again, it will come under the consumption, and the performance. The near term is not that much of great what we are seeing overall portfolio. Your view on Radico Khaitan to stick on to the portfolio.
So AVS, I think if you look at Radico, we've started to we added this name somewhere close to 1100, 1200. Today it's at 1700, despite a weak environment. So it has delivered better given the environment in which it is operating very clearly. Having said that, it is a play more on the consumer discretionary structural changes that we are witnessing at a society level. There is a sharp increase in consumption of premium product as far as the alcohol beverages are concerned. The premium side gives you pricing power. The premium side helps you improve margins. They've done a capex for backward integration as well. That should also add to margins. So while we expect earnings delivery to start or earnings delivery to get accelerated, so their pain point was probably FY24 as that capex was happening, and you saw a weaker environment play out on the discretionary side, which impacted more the popular segment and not the prestige and above segment. That segment has actually seen 20% revenue growth. So that is a segment which has done well. That is a segment which is a driver for margins and earnings growth from a more medium to long-term perspective. Having mentioned that, I think like other stocks where we believe that there has been some return delivery that has happened, which is upfronted. You've seen some degree of paring down of position even in Radico Khaitan as we create space for the other names in the portfolio. So this is an ongoing exercise at a portfolio level. We continue to review the portfolio on an ongoing basis to see that what is available to me in my universe set, is it a better return potential compared to what is there in the portfolio? So we continue to make those changes. So in light of that, you would have seen some degree of trimming of weights on Radico as we have created space for some of these new names that you mentioned, which is REC, Koel, Bale, Sudarshan Chemical. So we've actually taken some weights off there as well. So this will continue. We will continue to do this. We'll continue to reevaluate what is there in our universe, continue to change and churn the portfolio. But prima facie, Radico Khaitan per se, the thesis still continues to remain intact. You should see a faster delivery on volume and value, both for the prestige and above segment. That means margins will expand, plus the backward integration would add to the margin expansion as we look at.
Thank you. Participants request to type your questions in chat button question and answer session. We'll try answer them from the fund manager. Chetan, another question is, we have created from our channel partners on again on the metro brands, the premium consumption story. How do you look that consumption? Because it is also not played for last 12 to 14 months period. How do you see that consumption and premium consumption is going forward to happen? And what is your view on metro brands as a stock which you are holding in the portfolio?
So AVS, like I mentioned, I think the entire consumer discretionary pack has got hit by macro. So micro, if you go to each name, the story will again get back to the same answer that yes, macro was impacted. Consumption part of the economy has been weak. So if you look at private consumption itself within GDP today, that would have been in low single digit for this year, which has actually been a torchbearer for growth as far as the Indian economy is concerned. So you have been in this patch where consumption itself has not delivered in line with their own historical long-term trend. If the consumption does not deliver in a very shorter run period, what happens is that most of these companies will not slow down their store expansions. Store expansion plans are more medium to long term. You will want to lock properties and prime locations when they are available, as opposed to trying to lock them when that growth has come back and there is a higher demand for those same particular prime locations. So that means that in a near-term period, while earnings or revenue growth will disappoint you compared to your baseline expectation, there will be this added pressure of store expansion that comes and hits you below the operating profit line. So even in Metro Brand's case, the story is similar. So the story is clearly very similar to a Metro Brand or a Go Fashion or a Radico, where the macro has impacted. From a business store economics point of view, nothing has structurally changed. So our sense is, if you see a reasonable monsoon, you see recovery in consumer discretionary, this is a pocket which will start to do well. In Q4, what we witnessed is a lot of a bottoming out of earnings in this pocket has happened. So we've not seen incremental deterioration as far as delivery is concerned. When will the uptick happen? Like I mentioned, given how a large part of consumption in the country happens, which is clearly where the rural belt sees a fair degree of investments in the Kharif season. As that season moves on, as you see harvest coming and hitting the mandis, you start to see cash flows improve. That is where you see a high degree of reliance on the festive or period near about that, because that period coincides with when the monies are there in the hand to dispose. So our sense is that is how economy behaves, that is how the cash flow behaves in this economy, and that is where you will start to see recovery that starts to happen. What we are though keeping a very close eye on is, are things structurally deteriorating or have they bottomed out? So wherever we feel that things are structurally still deteriorating, we will take a call as things stand right now. Our sense is that we have not seen them deteriorating further in Q4 compared to Q3. We'll continue to keep a very close eye there.
Thanks, Chetan. We will take a final question for the day. So one of the investors asked in a Q&A session on a TCI Express. Can you please have some light on TCI Express?
Yeah, so I think I've covered it in the slide. We've exited TCI Express from
Express,
We've given it a fair degree of time. Again, it has also been in a way impacted by the macro, because for them the end user remains to a large extent consumer durables and textiles and fashion. That has been a pocket that had got impacted. But yes, we've given a lot of time to that name, and we finally decided to. That is a stock that we've exited.
Thank you so much, Chetan. There are no further questions in chat box and Q&A session. Would like to give your final comment for the day.
Sure. So thank you everyone for joining us for this quarterly call. Clearly, what we are looking out for from a very short-term perspective is the budget, which happens in July. We will get more clarity as far as the policy push for the next 5 years is concerned. As things stand right now, continuity of ministry points towards continuity of policy. So we will watch out for the commentary that happens on the budget and the budget speech itself, which will set the roadmap for the next 5 years. Another close thing that needs to be monitored is monsoons. I think we'll get more clarity because it's just June. We've seen monsoon arrive on time in a lot of the pockets already across the country. But we need to see this momentum continuing. Probably July mid or July end will be a time where we can have a fair degree of assessment of how the monsoon has played out in the first leg, and that will be crucial. So clearly for FY25 and 26, volume recovery is needed for earnings recovery. If the volume recovery happens, which is what we expect to happen given the commentary that has come through, our expectation is you will see a vicious circle of recovery happen across the board, one fueling the other. So the consumer or the consumption push will lead to capex, will lead to private capex. The government should continue with the public capex that they are making. So the government push on capex will continue. Capacity utilization already across a lot of industries are towards optimum. That means you will see a cycle of capex that will happen. So clearly, if the monsoons play out well, you see a vicious circle of uptake and acceleration of GDP growth continue. We've been delighted by the last quarter print of GDP, which has been higher than what all of us were anticipating. Our sense is the monsoon should continue to provide momentum. The continuity of the government should provide continuity of policy as well. But these are the two things that we'll watch out for. What this will also mean is that if you see a good monsoon, it will open an elbow room for RBI to ease monetary policy, and that should additionally add as a growth lever as far as more medium to long term is concerned. On the headwinds, clearly geopolitical risk remain a big headwind as far as the global economy itself is concerned. From a more domestic point of view, I think we are through with a very large event already in the month of June. So clearly the focus will now shift to execution of the government in the new third-year term. So that is what we are watching out for, both on the positive and the negative side. Expectation on balances that earnings acceleration happens. And we will continue to do our bit as far as actively churning the portfolio to recover the underperformance that we've seen in the last 2 to 3 years. Whenever the tailwind plays out from a lower cost of capital, that will be an added lever for re-rating whenever that. So with that, I will end the call, and I will thank everyone for joining us for this call. If there are any questions, please reach out to your distribution partners. They in turn will reach out to us. We'll be more than happy to clarify any questions, doubts, clarifications that you may have. Thank you once again for joining us for this call. Have a great weekend. Thank you, everyone. Thanks.
Thank you. Thank you so much, Chetan, for your time. And thank you so much, participants, joining in this call. This will end the webinar now. Thank you so much.